Can you guys hear me okay? All right, cool. So we are a small, intimate group, so hopefully a lot of questions and a lot of discussions. So I'm Gireesh Shrimali. I lead the transition finance research at the Oxford Sustainable Finance Group. And it's my pleasure to welcome you all to our summit. And today in this session, we are here to talk about environmental stress testing, case studies, and novel developments. So there has been a lot of discussion of climate financial risks and climate financial stress tests, and I'll define them shortly because it's not clear to everybody what they mean. But now you'll see that this has started to include broader environmental aspects such as nature and biodiversity, and which we hope to cover today as well. So the definitions, and this is just kind of a couple of minutes of just broad definitions. So when we say climate financial risk, this refers to the potential financial impact due to climate change, and it's usually approximated using different scenarios, and that will become more clear to you as we move along. But for example, you could be looking at a smooth transition to a net zero, and that's one scenario, and that's typically used for strategy purposes. But then we also look at stress scenarios that are used for stress testing that the central banks have been using. And in this case, for example, a rapid transition to net zero could be a stress scenario. Now the former, which is the broader climate financial risk assessment, falls under the umbrella of the so-called Task Force for Climate Financial Disclosures, which is TCFD. And now it's supported by a lot of countries around the world. And the later, which is the stress testing component, which is what we're going to focus mostly on today, it falls under the umbrella of the Network of Greening the Financial System, or NGFS, which is a network of more than 80 central banks. So with that kind of very high level, hopefully kind of brings all of us on the same page on what we're talking about. We now move on to our panel, where our distinguished panelists will discuss case studies and developments. And I'm happy to welcome from on my rightmost, Giulia Prodani, who is the Senior Policy Advisor, Financial Stability at the DNB, which is the Dutch National Bank. And then Martijn Regelink, next to Giulia, who is a Senior Financial Economist at the World Bank. And then Billy Suid, who is the Head of Climate Risk at Barclays. So I'm very happy to have three of them here, and they will be covering different aspects. And the plan today is we have about, now hour and 10 minutes, but I want to split this, or 20 minutes, and I want to kind of split this in three kind of segments. We will start with some opening statements by the panelists. Then I will have some Q&A with some questions that I have prepared, and then we'll open it up to you guys. And the idea is that we want to cover basically broader aspects of this environmental stress testing, kind of covering scenarios, looking at exposures, looking at vulnerabilities and financial impact, and finally financial stability. So with that, the idea is that we have this opening statement by each of the panelists, and we're going to kind of still stay pretty broad, and then in the Q&A we'll kind of go deeper. And I would like to start with inviting Giulia, and she will be looking at the central banker's perspective and also focusing on the EU. And so the kind of broad questions for Giulia, which you will see are kind of common to panelists, is what's happening at the EU level, in particular as part of the ECB, ESRB project. And for those who you don't know, Giulia is going to talk about it, but that this project, the ECB ESRB project, has constructed a unique granular mapping of the impact of climate change to the EU financial system. And then the idea is, what's happening, what are the key elements, what's been happening in the past, but also currently and what's likely to happen in the future. And then connecting this EU experience, I would request Giulia to talk a little bit about what is DNB and the central bank's perspective or experience with stress testing, what's worked well, what has not worked well, and what do you think is the way forward. So with that, I would like to hand over to Giulia.
Thanks. Good to be here. To start with, and to make a remark that links this discussion a bit with yesterday, I think yesterday some people were quite disappointed when someone mentioned, climate is quite difficult and we've done all this work, so maybe nature has to wait another 4 years or so. And to give a bit more perspective maybe to that statement, is that at least from the central banking or financial stability perspective, we started with climate around 5 years ago, at least when I speak from the Dutch central banking perspective. So in 2017, we started work on the first climate stress test. In 2018, exactly 5 years ago, we published the first climate stress test, and we followed that in 2020 and 2021 with other climate stress tests. Nature is quite new, so our first study in Nature is starts in 2020, and it was not really a stress test. It was just purely a first identification of what exposures are connected to nature. So just to say that this is what the difference in time between climate and nature is. And to put it a bit more into perspective, from a central banking perspective, we care about risks to financial stability. We want to make sure there are not too many losses in the system, that financial institutions continue to serve the economy. So to conduct a stress test, we usually look at 3 high-level steps. So we start with a scenario. The scenario can be a general economic scenario, but in this case, let's say a climate change scenario. So we say, what floods, for example, can happen in the Netherlands, or how the global warming can go, or how an energy transition can take place. This is the scenario, so the future state. And then we say, okay, in this future state, when this happens to the economy, then what are going to be the financial institutions' exposures that are most impacted? So we identify the exposures of financial institutions that are most likely to suffer in this imaginable future state. And then we go to, okay, what are the possible losses? So what are the actual vulnerabilities? Because maybe the exposures in scope can be 1 billion, but maybe only 1% of those fails. So we take these 3 steps, and in climate, we've done all these 3 steps. I mean, arguably, depending on the scenarios, you use the long-term, short-term time horizons. So everything differs, what they use at the NGFS and the ECB level, what we use at the Nederlandse Bank level. But at least we've taken all these steps, and we have come up with some estimates of potential losses. On the nature front, the conversation is only at identifying exposures. So we are not sure about scenarios. We don't have, like the NGFS climate scenarios, we don't have NGFS nature scenarios yet. And we are not sure what the vulnerabilities of financial institutions are to these scenarios. So at least what research has focused on the past 2 or so years from the central banking perspective has been, okay, at least we know what exposures our financial institutions have. And there are some databases that say exposures to certain industries are more or less dependent on nature and on nature's services, such as clean water or pollination or air quality. So we have identified these exposures, but we still don't have a best case estimate of what the losses to these exposures could be. This is what I'm also going to speak a bit more going forward, but maybe to say a few more things about the EU level. So at DNB, we've done 3 climate stress tests, transition and physical shock stress tests. At the EU level, or the single supervisory mechanism level, the ECB has done a stress test in 2021 and 2022. These are all seen as learning exercise stress tests. So none of these stress tests have resulted in a direct capital requirement increase for the institutions that were in scope of these stress tests. For nature, the plan is to, well, we have resources and are working on a nature sort of scenario analysis. Nothing is published yet, at least from the Dutch Central Bank perspective. We hope to publish a first nature scenario analysis before the end of this year. On what has worked well for climate, just to conclude, and on the way forward, for climate, what worked well for us was to choose specific scenarios to the Dutch economy. I mean, it's a global problem, but also the way that it materializes, it depends on the country. So for the Netherlands, for example, flood is a big problem because a quarter of the country is below sea level, so we focus on this. We also focus on the shorter term. So a challenge is how to reconcile the long-term horizon of climate change with the stress test, which usually has a short-term focus. So we chose to focus more on the shorter term and on simplification, of course. So everything that we do is a best case estimate for a certain scenario. We don't have the answer, and we're not sure if there ever will be a perfect answer, but sort of the message is clear that we need an orderly and timely transition, and that's what we find in our studies. And on the way forward, I think a lot of focus will be on nature and also on trying to maybe bridge nature and climate, because they are not two independent phenomena, but they are very interlinked. So we cannot solve the climate crisis without the nature, or the nature crisis without solving the climate crisis. I'll leave it at that. Thanks.
All right. Thank you, Julia. And with that, I would like to move over to Billy now with slightly different perspective, focusing on the UK, but also from a kind of commercial bank perspective, because Billy is at the Barclays. And the idea is basically the similar questions to Billy as well, what's happening at the UK level, and kind of you must have heard of the climate biennial exploratory scenario, also known as CBAS. And there is also, the Bank of England works very closely with the Climate Financial Risk Forum, also CFRF, where Billy is also in a leading position. So what's been happening in the UK? And then connecting that to what's been Barclays' experience in terms of the stress testing exercise, again, going into what's worked well, what has not, and how can we move forward?
Thanks for that. So I thought I'd probably start by, as you said, we're a commercial bank, so I thought I'd probably start by putting the scenario analysis in the context of kind of the bank's strategy on climate, and why scenario analysis is particularly important when it comes to climate, and we can then talk about some of the challenges and broaden into nature as well. So, like most financial institutions, our strategy around climate has really three components. There's one component which is providing financing or solutions to the people that are leading the transition. The second component is around shifting the emission profile of our portfolio, and then that's underpinned by risk management. I'm leaving out of this the work we do on our own operational footprint, which for a bank is not particularly material in the context of the emissions we have through our financing activity, right? So, scenario analysis is a core element of risk management. Leaving aside climate for a second, banks do scenario analysis and stress testing in particular as a matter of BAU by now. It was really a product, I think, of the 2008 global financial crisis that banks started to do more, and regulators as well, started to do more macro stress testing. So complementing the way that banks are typically run, how we measure risk, how we measure credit risk and market risk, and how we capitalize, how much capital we hold in order to go through those episodes. There's been the addition of those macro stress tests following 2008. So by now, it's a very well-trodden path. It's run on an annual basis. We do it for ourselves. We have a number of regulatory exercises we run on various jurisdictions where we operate. So the Fed has its program, the Bank of England, the ECB, and so on and so forth. So that's for macro, for typical business risk, I would say, for typical market risk. So in this space, what's interesting is stress test is an addition to other form of risk measurement. So in market risk, we have value at risk. In credit risk, we have credit grading, and we have RWA calculations, risk-weighted assets. And scenario analysis has come on top of those practices. What's interesting with climate is actually it doesn't come on top of anything else. It's probably, at this stage, the primary measure we have to express climate in dollars and pounds and pence and euros. So that's effectively reversing the historical practice of what got us into stress testing as an industry, and so that's striking. And for the reason why it's a primary is because, as we know, it's probably in the name, climate change is about change, so the future is different to the past. And as a result, all those empirical ways of looking at risk and looking at capital kind of don't apply. What we have to do is look forward, and that's the main way to go from kind of the basic identification element into putting dollar numbers and combining as well together portfolios that can be very different. You know, how do you equalize, if you will, the risk you have in lending to wholesale companies in various sectors, to the risk you have in retail portfolios like mortgages or other real assets, and stress testing is really what allows us to do all of that. In the context where the other methods we use in banking are not at this stage kind of applicable. So that's a bit of why scenario analysis is particularly important. I wanted to cover a little bit what we use it for. Right, and then maybe go into the more kind of geeky topics of kind of what scenarios and what methodologies and so on and so forth, which I find very interesting, but and probably some of you do too. But so the what we use it for, so that's important. It's part of risk identification. It's how do we, when we think about risk, we start with an intuition. Those sectors are probably more exposed, or those portfolios are probably more exposed. And in order to turn those intuitions into quantified elements, we need some sort of assessment. So for example, at Barclays, we, on the corporate side, I'll probably talk about corporate and then talk about mortgage and focus on those two portfolios because they're important for us. So on the corporate side, you start with, okay, there are probably a dozen of economic sectors that are very relevant for climate and for the climate transitions, and you start with an intuition of, okay, you have oil and gas and power and the transportation complex and housing, yeah. And you look at how much exposure you have to each of those sectors, and we're used to thinking in terms of credit parameters, right? So if you lend to a company that's very strong, let's call it a AAA, your risk is very different to if you lend to a company that's, let's say, it's sub-investment grade or leverage finance. The stress testing is what allows you to look at the impact of climate scenarios on those companies given their financial characteristics. And we draw lessons on that for the way we approach then our business and our risk management to specific sectors. And we identify as well counterparties where we want to be particularly mindful, and then that drive further risk work when we run our business, right? It's clients, business, it's transaction, and so on and so forth. We're also learning a lot, and hence every year we try to improve how we do this, and there are a lot of challenges and difficulties I'll come back to. And importantly then, once we have this pound or dollar number, it then allows us to think about what does that mean in the context of the financial resources that the bank has. And we have, you know, when I started my job, my team was created 3 years ago. And at the time, we didn't have any of that, and hence the way we assessed our own financial resources, our own capital position, or our own liquidity position for that matter, didn't incorporate those factors. And now that we have those dollar numbers, we've started including those assessments in the way we look at our own capital, and of course that's something that then our regulator takes a keen interest into. So increasingly we now also trying to incorporate it into the way we do financial planning, into our financial accounts, you know, impairment calculation and so on and so forth. And getting into a position where we define our appetite for the risk in a way that's more and more quantitative, and stress testing has an important role to play in that. So what have we done to date? Okay, so that's what have we done to date. We've run a stress test. We started a bit after the DNB, so we ran the first exercise in 2018, and pretty much every year since we've conducted at least one form of climate scenario analysis. We've done the Bank of England, CBES. That was quite a totemic exercise, I think, for us and for the UK financial sector. And since then, we've continued to evolve and run our own internal version of that. We've run a range of scenarios. Some of them are relatively short-term, 3 years, 5 years. Some of them are much longer. More recently, we have more focused on those shorter-term scenarios, which we feel are more indicative of the risks that we face and more interesting from that standpoint. Sometimes we run exercise on the whole balance sheet to try to have a systematic approach, with of course being proportional in how much attention we pay to each of them. And sometimes we then run very targeted exercise, a given sector, a given portfolio, and so on and so forth. And of course we look at physical and we look at transition risk. For us, what we've done so far has shown that transition risk is probably has the biggest impact. But of course we're mindful that the approach around the quantification of physical risk is more nascent, and there's probably much more second-order impact there that the scenarios we run have not really factored in. I'll finish maybe by saying a few words on modeling. There is a challenge there, right? So most of the modeling that that banks do and financial institutions do is really how to deal with a business cycle, right? So it's cyclical risk, and you try to assess how bad could it be in a downturn, effectively. Here we're dealing with structural changes. So transition is a structural risk, so it's probably a one-off or a series of one-off. It's very different from a cycle. And physical risk as well, it has a long-term drift with a lot of short-term uncertainty as well that unfortunately kind of materialize more and more obviously to us. So you have this challenge about how to deal with some structural changes in the context of models that have been designed to deal with cyclical changes. That's probably kind of a defining feature. And then of course the fact that then in order to assess those structural changes, you need to have kind of new types of data, a new type of parameter. Normal stress testing actually relies on a surprisingly small number of variables, bless you. So GDP, unemployment, inflation, those are typically the key macro variables that banks kind of look at when we run ourselves. And we use kind of correlation type of analysis to get us there. It tends not to be sector specific, let alone bottom-up counterparty specific. So here is something new that climate brings, is we need to do that junction between top-down model and bottom-up model. And we try to do that using a combination of approach. Sometimes, and we can talk about that some more later, I think, but sometimes we use pure expert-based judgment. So we do some ad hoc analysis, and then we scratch our head, we gather people around the table, we surface core issues and assumptions, and we try to put our best foot forward. In some other cases, we actually built models. We have published one on how to handle the modeling of large corporate cash flows, oil and gas, power, auto sector in particular, which I can share the link of if you're interested. So it's combining those approaches. Now, all of that, what I've said, is really focused on climate. Nature is an emerging area. It is even more complicated because you need to look at local aspects, which you don't necessarily need to consider when you do climate. There's kind of less data, less understanding, and so on and so forth. So we've started. We've run a pilot exercise following the TNFD LEAP framework, where you start with locating where the activities take place and which natural ecosystem it depends on, and try to work from that. So we've participated into the UNEP exercise, a pilot around the agricultural sector. For example, Barclays is a big bank for the agriculture sector in the UK. We have about £5 billion of exposure there. there's probably a handful of other sectors that needs to be tackled, and that's probably kind of an area where we are quite, we're only starting now. With climate, we started in 2018, and so we can hopefully work on in an accelerated way, learning some of the lessons, but it's much more complex and has a number of other dimensions as well. So that's where I will leave it there. Maybe Martin, for you to share your own experience.
Thank you, Billy. Really appreciate it, and we'll definitely get deeper into some of these aspects. But now, moving on to Martijn, and the idea is to now give you a perspective from a development bank, because Martin is at World Bank, and also what's been happening in the developing economies. The World Bank has been doing a lot of work there. So I guess the idea is, we heard about the EU and the UK, but what's happening in developing countries, what's different, and then, what's your experience with working with multiple countries? So you also get some cross-country comparisons. Also in developing countries, physical risk is likely to be a bigger issue, so we're talking a little bit about that as well. So yeah, with that, I would like to hand it over to Martijn for his opening comments.
Yeah, thanks a lot. And one thing that's different is that I'm going to use some slides. We are obviously here with very cutting-edge institutions. Not that slides are so cutting edge, but at least I differentiate myself a little bit. As was introduced, Martijn Regeling, I'm leading our work on climate risk analysis and work with supervisors globally. And beforehand, actually, I was also with DNB doing some of that stress testing work in 2017. And I know some of the people here in the room also worked with me on that. Let's maybe initially try to set a bit of context for emerging market and developing economies and the way we look at it, because I think it's very important on how it informs basically our work with central banks and regulators in the developing world. So if we go to the first slide, I think this shows quite clearly that physical risk in particular is, I have to do that myself. Very good, it's easier. I think this shows quite clearly that developing countries are highly exposed to climate physical risk. We know that has been historically the case. Particularly Asia has been high up the ranks in terms of exposure to floods, hurricanes, those type of things. In sub-Saharan Africa, we know there's a lot of drought-related issues, often not monitored very well in the statistics. But if you compare it, and this is a figure on the left-hand side from S&P Global, if you compare it to basically developed countries, we see that the emerging market and developing economies just have much higher exposure to some of these physical risk issues, putting a lot of economic value at risk. I think here it's estimated that by 2050 it's up to 14% on average for South Asia, for example. So World Bank also did recently quite a bit of macro modeling to understand what the GDP impacts are. We have this new report. It's called Country Climate and Development Reports. It's done for most of our client countries. Really informative, trying to find that narrative between whole of economy climate approaches, but also how that fits with development issues, which obviously are much to the forefront in our client countries. A lot also on investment needs. But some of the information on climate risk is also really informative. On the right-hand side, you see the impacts of I think 25 or so countries that we have assessed, and it finds that it basically confirms some of the S&P Global findings that climate change can have really material impacts to economies, even up to 12%, I think already, average economic loss against the baseline by 2030 for some of the highly exposed countries. In this case, I think Mali, Niger, and Pakistan are high up there. And I think what is important is that you need to consider some of these impacts in already, let's say, weaker macro financial environments where countries are struggling with debt issues. There's often also, if you look at the financial sector structure, a lack of insurability of some of these impacts, and that obviously has a lot of implications for households, firms, and with that also the exposures that banks have on some of these these counterparts. And just one last thing, I think what we also often see is, the intertwine of, say, climate issues with broader environmental issues. I visited Bangladesh a few times. That's one of those countries, right? Flooding every year, I think up to 20% of the land, in some years even 60%. The land floods, but the water is also, very polluted, amongst others from some of the issues around the garment industry. So the flooded water gets into the soil, the pollution gets into the soil, the food gets on the plates, and that obviously has a lot of impacts on human health. So there's all these interactions as well between climate and environment that we take into account also in our stress testing. So if we go, and again it's myself, to the next slide, I think meanwhile, transition risks are also critical, right? Particularly in some of the larger emerging markets that are fastly developing. We know that many of the low-income countries are small emitters, but nonetheless, you don't want to lock in, let's say, technologies or power production that down the road will be an issue for your economy and also potentially your financial sector. So all countries, to some degree, need to take this into account. But we also need to recognize, by now, I think only Asia already is over half of global emissions, right? And I think particularly for these rapidly developing, larger emerging economies, transition risks are important. For example, China, we did some work on that as well. We found that they need to decouple even faster than what they're doing currently. So such a pathway, a transition pathway, can be rocky. And again, some of our macroeconomic modeling shows that there's a lot of uncertainty. There's a lot of variety in impacts, but we do find that they could lose, I think, up to 6% of GDP by 2030 or 40. I cannot read the exact number here. And I think drivers of this are a little bit different to some degree that we see in developed countries. There's a lot of down the value chain impact, I would say, right? Some of these countries are large producers of natural resources or manufacturing products that are again used as inputs in European final manufacturing or consumption or in other developed countries. So this creates different type of scenarios to some degree than maybe only a local carbon price that could be introduced. It's also really about how maybe other countries may impose trade restrictions, like we see now currently with the carbon border adjustment mechanism in the EU. So these are the type of scenarios that then play into our work when we assess the impacts on the financial sector. So this gives a bit of an overview of what the World Bank is doing. I think, as it was already highlighted by Julia as well, stress testing is really a critical tool, I would say, for supervisors to first understand some of the risks and also build some of the capacity, but then also, figure out how that can play a role in supervisory guidance, for example, to financial institutions. And we see that financial institutions, I find that very fascinating, are already actually, leading a little bit in taking some of those outcomes into account in their own, own risk assessments and also whether they need more capital for it. But I think we also need to recognize that in emerging markets, this work is nascent, right? And it's nascent at the supervisory level. While we have seen a lot of climate risk assessments in developed countries, in emerging markets, it's still only a handful. Many of them actually supported by either the World Bank or IMF. And also, if we go to the banks and have, discussions with them, we see that there's not yet that type of deep understanding or modeling capacity available. So World Bank, supports these countries, often as part of broader country programs, and we really try to tease out the specific scenarios that are relevant for particular countries. So here you have a bunch of examples. In Morocco, we are working with the Bank Al Maghrib on drought stress testing. I was just in a session on water stress, so super relevant. South Africa, a lot about transition risks, some very large emitters. Mexico, we work jointly through the financial sector assessment program we do with the IMF on a season of different climatic events, because it's a very big country. So one climate event will not directly lead to maybe stability issues, but if you have like multiple floods and a hurricane on top of that in multiple regions, that may play out very different. Philippines, Colombia, I touch upon some later slides, but we worked on hurricane and flood amongst others. And then Malaysia, of course, we talked a bit about the new type of work. We also look at nature risk. And this, again, is part of broader programs. We do not only look at risk management, we'll also look at the insurance sector, for example, that can help, offset some of the risks that are out there. We also help with a lot of green finance related issues. How do you create the enabling environment for blended finance? And obviously, for bank balance sheets, that's also very important, right? You need to have an alternative to, let's say, your climate risky assets. So on the next slide, this tells a bit about our approach. I think it's very similar to what we heard also from the Dutch central bank. We often start first with a diagnostic, just to get a picture on what are actually the loan and other asset exposures to climate, physical and transition risk. We map them out by sector and by region. Often not easy, because that data is not always available, but I think it's a very important first, quite easier step to get that broader picture of vulnerability. So then if a country, has the capacity, or if we think there is capacity in terms of data, etc., we do more deeper analytics, and that often starts, that obviously starts with a scenario, building the scenarios, as I said, country specific. On physical risk, I think the primary indicator that we look at is damages. So damages to capital stock, basically from climate events, various hazards. And we use a lot of CAT modeling for that has been developed in the insurance industry. And that is a key indicator that we then put into macro models, amongst others. On the transition risk, I think the key indicator is often a carbon price, whether local or global. It's a sort of proxy, right, for all types that can happen around technology, policy, even market sentiment. But also increasingly these trade-related scenarios. For example, European countries may introduce the CBAM measures more widely. What impact does that have on a variety of industries which a particular country is exposed to? Then lastly, on the scenarios, I think increasingly we also look at these compounding scenarios, right? I already explained often these climate issues happen in correlation with different type of risks. So we look at compounding in terms of, already weaker macroeconomic environment with then on top of that a climate scenario or different climate and nature scenarios combined. The modeling, I think, is the third step. Here we have two type of approaches, you could say. It's more the macro approach, where you take, let's say, the impacts on damages and then capital stock into a macroeconomic model and look what that means for GDP and other type of relevant metrics like inflation, interest rates. But increasingly, we also try to do that more at the micro level. So what does it really mean for firms, right? Can we have an, sort of conclusion what it means for corporate balance sheets? So that type of, but it's not always easy to do, obviously, in data-constrained environments. And that information, lastly, is then taken into the financial impact, where we, make the connection to the probability of default, the loss given default, or more easier, the non-performing loans in a certain country, the provisioning that banks have to make, the impacts on the, say, the profit and loss account, as well as then the balance sheet positions and the capital adequacy as a measure, let's say, of the solvency of the banking sector. So this is a little bit the modeling chain. Then if we go to some of the examples, I think this was actually, we worked on the Philippines with a colleague who's now at Oxford, Nicole Ranger. And here we looked at, how a typhoon could affect the Philippine financial sector. So the country is already highly exposed to climate physical risk. They have 19 typhoons affecting the country. 8 of them make landfall. Some of the largest typhoons in the world have been registered for that country. And we looked specifically if one would affect Manila, the capital of the country, where most of the economic activity takes place. 85% of the loans is originated. So we then looked at what would a 1 in 500 year typhoon, a super typhoon infused by climate change, do for the country, and we developed jointly with the IMF an innovative macro stress test to find that out, connecting global climate models with CAT modeling and then also macro financial modeling. I think in terms of the findings, we find that climate has very severe impacts on the capital stock. For example, the damages to infrastructure from a mega typhoon would go up by 50%. In the next 2 decades. We also see that on GDP level, it's very systemic. GDP could be affected by 14% point in such an event, which is similar to what they experienced during the Asia crisis and even more than they experienced during the financial crisis. But the good news is for banks that they were modestly impacted in most scenarios because they had good capital buffers and had done quite well over the years. But if we took a more compounding scenario, and that's what you see on the right-hand side, so we basically had a scenario where during a pandemic, we would on top of that have a climate event like a super typhoon. Then we saw that a lot of banks dropped down the minimal capital requirement. And this was timely because this stress test was finalized in 2021. We started in 2019 and then, you know, we had the pandemic. Obviously, we first didn't label it pandemic, but then the pandemic came and it was a very stressful macro financial situation. So the next example is on Colombia. Let me go there. And I do it quickly. I know I'm taking a bit too much time. Here we go from basically an integrated, this is a transition stress test we did with the Colombian Central Bank and the banking regulator. So here you go from an integrated assessment model where you first estimate different carbon pricing pathways aligned with the national determined contributions. So that's top left-hand side. The country has a very ambitious target of 50% CO2 reductions by 2030. They scaled up their ambition, and we calculated what the carbon price should be. And that information was then used in a macro model, which could distinguish between a sector value add, and we found quite high impacts on some of the expected industries, right? You know, around coal production, for example. That information was then used into a credit risk model, a sectoral credit risk model to estimate the impacts on corporates, and that was again connected to bank balance sheets. What we found on average was again that the impact was quite manageable, up to I think 1 or 2 percentage points. But if you go bank by bank, so it's really the devil is in the detail, there was quite some heterogeneity among banks. And I would say that's a more generic conclusion that we make across, let's say, these assessments, that often the devil is in the detail and that you really need to go bank by bank. Lastly, and I'll be very quick here, just about high level some of the challenges that we see, and I know we go further into that. There's of course the huge data gap that we are dealing with. It's at the financial asset level where there's not always you know, the granular loan level data. The climate data is not always there, like CO2 emissions per sector, for example. All that type of stuff needs to be addressed. Better incorporation of climate and compounding effects in macro modeling. I mean, macro modeling, there's a lot to say. A lot needs to be improved. These models were not originally developed for climate impacts. But, you know, we now have these new challenges, and this forward look to get that in these models is definitely a huge challenge, and we worked a bit on that in the Philippines. Lastly is, building the capacity, human capacity. Often it's not there in many of the countries that we work, so a lot of training is put in place. And then also finding what it means for further, you know, the supervisory approach, the supervisory guidance, and how to deal with that are some of the challenges. And I know we go deeper into that, so I finalize with that.
Thank you, Martin. All right, so that's great. So hopefully that was more of an overview of kind of different perspectives. And now it's for Q&A. I'll start with some of my questions. And the way I've kind of thought about my questions is basically 3 categories. And there we'll come to audience questions in a bit. Don't worry, I'll get to you. So the idea is that I wanted to kind of split it into 3 categories. Methodologies and implementation is the second one, and I know they're connected. And sometimes the boundaries are not that clear. And then also looking at some applications, and we kind of talked about nature already. So let's just start with some discussion around methodological challenges, and we kind of started talking about that a little bit. So my first question is to Billy, and you know, Billy kind of mentioned that they classically look at, as a practitioner, they look at credit risk and they look at capital requirements, and you know, the real challenge is how do you integrate climate into the classical kind of whatever banks do in terms of estimating credit risk and capital requirements. So from a practitioner's perspective, how are you integrating climate into your kind of existing models, and what do you see happening there?
Okay. Given the number of hands that raised, I'll go quick on the answer to give margins. But so, in the question, you talk about integration, right? So, at this stage, I think it's fair to say we are not integrating, really. We are bolting on, is more like how I would describe the approach. So, I've described previously the difficulty in, taking something that is designed for cyclical change, that consumes high-level variables, and into making it into something that responds to climate, right? Martin talked about the scenario, so I won't go there, and I'll focus on, given a scenario, if you will, what happens there. And so we have to put our best foot forward, and the way we put our best foot forward at this stage is by doing those add-on approach. So typically it would be something like, we have a credit model that takes a given credit rating and projects what could happen to it under stress. And what we do then, and that's not climate aware at all. So what we try to do is we say, okay, so what would be, let's take into account the climate characteristics of the scenario. What would those characteristics change into the financial strength of a given company? And then we can then project. And so effectively using what we have and feed into it inputs that have been adjusted for climate, if you will. The same with mortgages. So real estate, of course, is exposed to both physical risk as well as transition risk. So you need to think in terms of what's going to be the impact on the characteristic of the property we're talking about, right? Either is a property is less valuable. You need to think about the impact on the borrower. Is his own, let's say, available income going to get impacted? And then you have to cross the two together to have a sense of what does that mean for what kind of impairment you may suffer. So as to give you an idea of the kind of things that we're trying to do. And in parallel to that, we have kind of a series of what we call quants, so kind of people in the bank that are tasked with designing models. And we are in the process of kind of mapping out all the kind of credit models we use. They'll tell you that we have some backward-looking regression models, some forward-looking regression models, some stochastic models. We have a series of model suite that we use to tie a credit risk all together. And so we're in the process of working out what's a way to inject climate into inputs as well as into calculation processes. And a lot of it comes down to belief, which means assumptions, because you can't calibrate any of it to history. So you're gonna have to make an assessment, for example, on things like what's the level of correlation between climate and macro impact. Martin talked about you take typhoon on its own, the impact is manageable. You put typhoon and pandemic driven macro shock, and suddenly the impact is more severe. So that element of correlation, how additive those things are to each other, is probably an area where we have the biggest assumptions to make. And so we're in the process of laying that out and exploring that.
Cool. All right, so my next question is to Julia. Moving from a kind of a private perspective to a central bank perspective, and you kind of mentioned this issue of financial stability. So what do you see from a climate perspective? Are you seeing there's an issue for climate kind of financial stability? And then, given the experience that we have had so far, do we need to think about it differently going forward?
Yeah. I mean, financial stability is in the mandate of all central banks, I think. So we start, our job is to safeguard financial stability. And how we do that, we look at immediate risks and we also look a bit forward. There's no specific time horizon, but let's say maybe less than 10 years typically. In the case of climate and many other risks, the future is uncertain. So we do this scenario analysis and we typically focus, the risks lie in the tail, we call them. So if you have all the scenarios and you have a probability of all scenarios, we focus on the tail scenarios, so the worst case ones. And the aim is to look for vulnerabilities and to understand the transmission channels and what happens in the tail. So for climate stress testing, we're really try to look at that. And what is nice about it is that we don't have to say that this is the way, we just map a few different ways and we understand the transmission channels, and we also have a quantified answer to what exposures are in scope and what losses could be incurred by financial institutions in these scenarios. We, of course, are responsible for the financial stability of the Netherlands. So what we look at is scenarios that are specifically relevant to the Netherlands. In some cases, they overlap with global scenarios. So carbon pricing is a bit maybe bigger than the Netherlands and carbon emissions. So what we've done is we looked at energy transition stress tests, for example, and we assume a disorderly transition. So we just increase the carbon price. And we see how the economy changes and what the bank's losses are. As I said, we've also looked at a flood scenario and, flood scenario at a range of flood scenarios. So we start at maybe one area of the Netherlands is inundated, or maybe the biggest part of the area is inundated. And we try to do these scenarios, and the challenge is, to sort of reconcile severe but plausible scenario. So what is a severe and plausible scenario? Because that is what we need banks to be able to withstand. But the reality is we can assign no specific probabilities to these scenarios. So how we approach it from the Dutch Central Bank perspective sometimes is we just do what-if scenarios. So we say this scenario is severe, it could happen. And then we just look at the range. So, for example, for the flood risk scenario, we try to do a reverse stress test. So we said what amount of flood risk is needed, or what amount of areas do have to be underwater for there to be a financial stability risk. So we looked at the range of scenarios, and we see for the less severe scenarios that inundate areas that are not severely populated, then banks, of course, can withstand the scenario very well. But for scenarios in which even protected areas could be inundated, and where the biggest economy and population of the Netherlands resides, quickly the financial losses really impact the capital buffers of banks, and sometimes go even below minimum requirements. So this is how we try to address the challenge of, what is a plausible but severe. So we take a range of options. We also really focus on the short term. So in the long term, of course, banks, financial institutions can shift their exposures. Also, there is bigger uncertainty. So we really try to focus on 3 to 5 years. And for this, of course, many assumptions are made, but at least it gives us an understanding of how this scenario could unfold. What was a big challenge in the beginning when we started with this was, and as Billy said, of course, stress tests have been used in the banking industry and larger for a number of years, but these are not models that were made for climate risks. So the first challenge was how to connect a climate scenario that says how the price of carbon will go, or where global warming will be, to the models that we have. And the models that we have are typically macroeconomic models and stress test models, and the inputs they have are, as Martijn said, GDP, interest rates, inflation. So the first challenge was how to make a climate or a nature storyline to fit into these economic factors, which is not perfect. But for example, for the disorderly transition scenario, we did that with a link with the carbon pricing, which now many models have. And then the model itself gives us sort of a consistent scenario that if the pricing goes this way, then these other things are likely to happen with the economy. So connecting the climate, let's say, variables to the economic variables that we're used to dealing with was a big challenge. Maybe last point, of course, the climate change is quite complex, so we relied a lot on simplifications. I mean, when we talk about physical risks posed to the Netherlands, we take the flood scenario. Probably that's not the only physical risk scenario that can impact the Netherlands. So I think all scenarios that we do and that focus on a specific thing really give an impact for that specific scenario and don't really encompass or show the big magnitude of even interacting risks in climate, but also in nature. So for our energy transition stress test, we focus on CO2 emissions, CO2 pricing, CO2 emission intensity. Of course, CO2 is not the only thing that we care about when we speak about climate, but this is sort of how we try to simplify in order to move forward, and I think it's very much a learning exercise, and yeah, we're lucky to have these international collaborations. I think collaboration comes up a lot, also at the NGFS, where we share a lot of knowledge on how to move forward. So. Thank
you, Julia. And with that, my next question is for Martijn, and actually I'm going to combine two questions. So it's going to be a longer one. So the idea is this, you know, you heard about the approaches for the private sector and the kind of the OECD countries, but how do you adapt these current approaches to developing countries? And you kind of started to talk about the capacity issue, and you also talked about, you know, you do a lot of macro testing, so how do you go from macro to micro, et cetera? And then, you know, what are the implications and kind of use cases for supervisors and industry? So kind of a loaded question, but hopefully you can cover all of that.
Yeah, I can do another 15 minutes probably on this one alone, but I'll try to be a little bit briefer. You know, we do a lot of, let's say, we adopt a lot of the approaches that, you know, other cutting-edge supervisors have developed. But from our end, it's very important to adopt it in a sort of a modular way. So we have a bit of a modular approach at the World Bank because the heterogeneity among emerging markets, developing economies is enormous, right? Some operate like almost developed countries. Others are very low-income countries with very little capacity to do this stuff, and it's very hard for them also to get the right data. If I unpack that a little bit, I think, first of all, there's the sort of the scope of that. So you know, I talked about the sort of generic approach, and the first step that we take usually is a diagnostic. And I think a diagnostic on, let's say, the exposures, the physical risk and transition risk exposures, and sort of the loan level data that you can map around that in terms of sectoral exposure and regional exposure, and then compare that with some sort of physical risk or transition risk mapping. So that's a step that we think we can almost do in all countries. And for some it may be much more granular than for others. Some supervisors have some of that data in-house, let's say, the loan level data. Others need to go to the industry where it's collected by certain banks, and then we can still have a picture. And I think that's definitely something we do in a lot of countries. I think we do it in over 20 or 25 countries, this type of assessment. Then the next, you know, modular way would be more simplified historical relationships. So particularly on the physical risk side, as I said, a lot of the physical risks are already there in these countries. So in Colombia, for example, there's already a lot of flooding in the country, etc. And we know on a regional basis what that does to GDP and even what it does to non-performing loans. Philippines, similar story. So you could basically make a direct connection, right, between the damages and what it does to NPLs and what that does to the bank balance sheet. And then you can scale it a little bit in a smart way with what climate models would say around the impacts and how they would increase. If countries, you know, if there's macro modeling available, or if we can develop it, that's then maybe sort of the next step. Certain, you know, higher level macro model, like we did in the Philippines on a country basis, where you look what it does for GDP, etc. And then the most micro approach is really to run through the firm and corporate level, right, where you have maybe, you know, climate models, you go to macro impacts, but then scale that macro impact again to corporate balance sheets and connect that to financial sector impacts. That is hard in many countries, but we are now approaching it. So that's, you know, one thing. I think also work with models on the ground. So NGFS has, you know, these great scenario outputs, but they're usually not available on a detailed level for emerging markets, and also not always the best source, right? NGFS works with one particular macro model provider. There are many other macro models available at the country level sometimes as well, which are even better or more tailored or can give more granular sectoral inputs, for example. Then on the data, I think we try to make smart tweaks, right? So if you try to identify exposed sectors or whatever, this scope 1, 2, 3 emission data is useful, but it's usually not available, or we only have, for example, scope 1 data. And then you use input-output tables to, for example, estimate your own scope 2 data. So these are the type of tweaks that we make. We try to estimate PDs by looking at non-performing loans over time. Geo-distribution of loans is very important, but the way loans are collected often in markets is they're collected at the point of origination. So you would see huge bulk of loans in, say, a capital, but that's just because the head office of a certain firm is there or a branch of a bank is there, while the assets may be spread out in the country. So we look at ways to compare basically the loan distribution with the asset distribution across the country and then tweak it or do robustness checks. So those are ways that we adopt approaches. And then on your second question on the use case, let me highlight a few things. I think still very important is awareness raising. So this is not as widespread adopted in emerging markets as it is in developed countries. In that sense, it's not as different as when I worked at the Dutch central bank. I told you before we started, I had quite some meltdowns in the beginning when I had to talk about, and this is 6, 7 years ago, to the DNB board around how climate risk is affecting the financial sector. And you saw these more traditional risk managers really, I don't know, this does seem to be a bit far off. Then we had the luck of Frank Elderson, really a leader who picked it up. And these leaders are everywhere. They're also in emerging markets. So you really still need to tease out that story, use the central bank also to bring it to a larger audience. In the Netherlands, it was brought to the parliament's attention, and it really got a big thing from there. So I think awareness raising is key. Then build the capacity. So use it as a training tool, both internally at the supervisor, but also, for financial institutions. Is still very important, is probably really a key instrument. Identify data gaps, as I talked about, what is available in terms of your loan level data or other asset classes, what climate data you need to bring. And then the supervisory approach, I think we heard already a little bit about it, what you need to really think of not only use it in macro prudential modeling and monitoring, but also the micro prudential, and what type of guidance and methodologies are you going to provide. And that's not always easy, and it's not really commonly adopted yet, but it is sort of the pathway that supervisors are taking. And in the Philippines, for example, based on our work, they have now sort of guidance for the financial sector, for the banks to run these physical risk stress tests. And I think what it means for industry, Billy already touched upon.
Thank you, Martin. And actually connecting to Julia on that, this climate stress testing and the issue of financial stability, but what's the implication for regulators in terms of, setting for the regulations or policy recommendations? So what's been happening on that front?
Yeah, good question. As I mentioned, climate stress tests have been happening for some time, but they are still largely learning exercises. So, at the Dutch Central Bank level, we've done 3 such exercises. At the ECB level, 2 such exercises. Neither of them have had any direct capital impact for banks. But the policy discussion is quite broad, right? So we look at the stress tests. Quite some of them have a disorderly transition path. And you can clearly see that a disorderly transition leads to much more losses than an orderly transition. And you can also see that in the very longer term, the physical risk losses really are bigger than the transition risk losses, even for developed countries such as the EU. So this is the ECB stress test that showed this. So a clear policy message, not so much, or not only from a central banking perspective, is that the transition is needed to be timely and orderly. So we need a clear policy signal also from the governments and also a transition path. I think that's something important. More specifically from the central bank perspective, the policy discussion on what prudential tools central bankers can use is also still in its infancy, but is happening in parallel. And depending on who you ask, some people are in favor of it happening in parallel, and some people say, oh, let's wait until the stress tests have a really robust result and then move on to policy. Currently, the prudential regulation discussion is happening. So there is a discussion, should we impose a concentration limit? For example, a bank should have a certain number of exposures to the oil and gas sector, we say? Or should we have a limit on exposures to a certain area that is prone to fire or flood, etc.? So that is one policy tool. Or it could be, okay, do we need just a capital buffer extra for these sectoral exposures to sectors that seem to really be impacted by a disorderly transition or biophysical risk scenario? This is not settled yet, so there are working groups at the European and international level, and there are still no sort of binding, at least minimum requirements, right? On the other side, there are, let's say, softer tools, so Pillar 2 tools. So the ECB, I think in 2020, already published a guide on the management of climate and environmental risks. And that's applicable to the significant banks in the EU. At DNB, we also implemented that for less significant institutions, so for all institutions. And there are, by the nature of this guidance, it's supposed to be banks' own risk management. So there are no specific minimum requirements imposed, but a lot of qualitative requirements. And the ECB already started checking for compliance with this guide. However, the guide is only fully applicable by 2024, so a lot of work still has to be done. Yeah, so it's very much a work in progress, I would say, but there are steps that seem that they could lead to more fixed prudential policy measures, maybe at the European level, not very far into the future.
Thank you, Julia. And my next question is actually something that's one of my favorite questions. And this is the issue of when you're looking at transition risk, and one of the issues is, are we even calibrating to the current pace of transition? And that gets into this whole question of, you know, are the current scenarios that are being used around the world, are they really capturing stress situations, right? And so this is the question to Billy, but also, you know, while answering this question, you know, and we did some work on this as well, that the current scenarios are perhaps not stress scenarios. So then how do you think about creating stress scenario?
Yeah, that's a tough one, but clearly very important. Look, the range of views out there about the speed at which we are currently on track for is very large. So you go, and I don't know for those of you who read the Rocky Mountain Institute, but they have this great chart in their energy presentation where they show the range of views on that, where at the bottom you have people who predict effectively flat usage of fossil fuel throughout the decade. And then progressively you go all the way to people like the Oxford Institute of New Economic Thinking, that actually predict that just based on current everything, and given the typical S-curves you see in technological transition, they actually expect, as kind of their base case, to have renewables adoption and reduction in fossil fuel demand that is larger than what something like the IEA net zero scenario predicts. Oh, sorry, not predicts, because it's prediction. What the IEA net zero scenario says is compatible with a 1.5 degree world. So you have that huge range of views out there. And so that makes it difficult to pick a plausible, kind of a plausible but severe, and that of course has a lot of consequences in terms of how the investment decision, risk analysis, lending decisions, etc. Are done. So, and it's particularly, because it's a structural shift, it's particularly difficult to express it in terms of likelihood or probability. So yeah, we have this very wide range at this stage, and it does pose a question as to what is baseline compared to what is stress. So we're working to get to a place where at least we can have central views that we use kind of consistently in our own planning and stress testing, it's quite unresolved because it's belief based. I think the work from INET, from the Oxford INET, is quite interesting as well as the work from others like Reichstadt Energy, take completely different approach, but it leads them to be able to express things in a probability, potentially in a probability way, which is interesting. If you can have a likely and a 1 sigma on either side, suddenly you start thinking in terms that are very natural for financial institutions to pick up.
Thank you, Billy. And did you guys want to add to this question? Because I know you're thinking about the stress scenarios as well, so anything you might want to add?
Well, I don't know if you want to go first. I think what is for, like, if you look at the EMDs, I think the pace of transition, of course, we know it needs to be stepped up, but what I always try to take into account in some of the scenarios is, so there's some factors that countries can control, let's say on the policy front in particular, locally, right? And it may be quite unlikely that a particular country will introduce policies that would blow up, let's say, their economy or their financial system, right? But then again, there's also a lot of forces that countries do not have in control. I think the technological innovation is one, but also the sort of policies that come from abroad, and the developed countries that introduce these carbon border adjustment mechanisms. This is now maybe not that impactful at this point, but it may be scaled up. So those type of issues may very much bring some of the transition aspects much more forward and in play. And one other point I would like to say is, and this is something we looked at a little bit in the Mexico context as well, is just from a stress testing point of view, the market is of course always forward-looking, and investors are forward-looking, which basically means that they may make decisions today on things that may only happen in 5 years' time. So they may also by doing so, bring some of the transition effects forward. And this is also something you need to take into account when you do the modeling, so these market preferences. And that is definitely a very tricky thing and a thing to do at this stage.
Thank you. Julia, did you want to add?
Yeah, I think it's quite similar, and I think the only thing we do is to just sort of try to bring forward these possible shocks. So not really let them materialize in this long-term orderly way, but especially for the stress scenarios, to try to impose all these shocks as sudden shocks that would happen now or next year. But of course, that's all based on assumptions, right?
Thank you. All right, so I said I'll ask some questions and I'll let you ask some questions, and I think a lot of you are dying to ask questions, and I still have a lot of more questions to go. So what do I do? But I'm watching time, right? So I'll skip my remaining questions and go directly to audience. So Tom.
Is this on? Can you hear us?
Tom's here, so let's start with Susanna, because I know she's really wanting to ask a question. So we'll start with here, and then I'll go. And what you do is, please introduce yourself, your organization, and also when you're asking the question, if you can address the panelists that you have the question to, and you could also ask the question to the whole panel.
Okay, thank you. So I'll start. So I'm Susanna Saran. I'm from Oxford, from the Institute for New Economic Thinking, as you mentioned. So the question I'll ask, it has been discussed somehow, but I'm still wondering, so all those risks are quite interlinked, right, related. So at some point we will come to bottom-up stress tests and capital requirements, prudential requirements, so which will result from those stress tests. So we cannot run different stress tests for different for all those risks in parallel, right? So my question is more for the regulator. So we know that all these risks are interlinked, so we cannot impose different capital requirements for these risks. So you mentioned nature risk and climate risk, which are quite interlinked. We cannot treat them separately. And the same for, let's say, regular financial risks like market risk, credit risk, and liquidity risks. So at some point, EBA will run some like one single stress test, and my question is, and they will be for sure bottom up. So my question is, how the regulator handles this, the issue of these multiple stress tests and the future link with regulatory and prudential requirements.
All right.
Can I have another? Can I ask another question?
All right. So.
Yeah. Yeah. Yeah, difficult question. I'll try my best to answer. Maybe two things. I'm not sure if it's going to fully satisfy your question. But the first thing, I mean, we do all these separate stress tests because it's very difficult to do more than that. So it's very difficult to model how climate and nature interact, and even within nature, how difficult nature components interact. So when we speak about the services we get from nature, we get pollination, we get clean air from the forests. There are very few models, or none of the models that we have at our disposal now, that really show these interconnections between nature services and what happens if bees die, then what happens to forests, etc. That's why in all stress testing we say this is sort of a lower limit, or how to say, an underestimation of the real impact. This is one safeguard we put. In recognition of this, I think there's quite some work plans also at the global level, so at the Network for Greening the Financial System, so the NGFS level. Now they have climate scenarios. Since last year, there is a new task force on nature. The aim of that is to embed nature into the NGFS's day-to-day work, which means that if possible in the future, there would ideally be climate-nature scenarios. So we don't have to run climate scenarios and then nature scenarios, and within nature different ones, but maybe see to what extent they could be combined and interlinked. Of course, that is also very difficult because especially nature is very local, even more so than with climate. So we are still in the process of figuring out how that work will look like. It might as well be that it will have a more local dimension, sort of a matrix dimension of what risks would be what permanent for what countries. Yeah, so it's very much under discussion, and that is also the reason why we don't have any minimum capital requirements on the results of these stress tests.
Thank you. Next question over there. Okay.
Jimena Alvarez, I'm based at the University of Oxford, so it follows up on Susanna's point. I'm working with a project led by Nicola Ranger on integrating nature climate analytics and scenarios of financial decision making with a focus on central banks and supervisors. So within that, we are doing a use case in the UK, commissioned by the Green Finance Institute and DEFRA, with involvement from the Bank of England, and we're also part of the NGFS working group on nature scenarios. So I guess my point it would be, wouldn't it make more sense to try to do nature and climate together, despite the difficulties? Because it is very much, I'm aware of ENCORE, the tool that used by DNB and others, and how the local dimension is not into there. So then you have Banque de France, which incorporates all the dependencies in the analysis. But if you're going to try to tackle nature, perhaps just doing nature and climate in the framework, so you don't have to do really too tough, difficult things. Do nature first, and then nature, climate, and then we're talking 10 years down the line. So, yeah, sorry.
And that's a question for Julia.
No, I think Julia already gave an answer, perhaps Billy or Martijn.
Okay.
I think we can all agree with the fact that those things are in the real world related, right? So then maybe I'm a bit of a pragmatist, which is you need to do something that's useful, and it may not be kind of modeling explicitly all those things and those feedback loops and etc. But you're right, it's going to take a long time to kind of get there. So in the meantime, we need to put our best foot forward, right? And by the way, it's not just climate and nature; it's macro climate and nature kind of doing together. So we are. I think we're all aware that this work and this framing kind of needs to happen. I'm aware of the work you're involved with. I'm part of a group convened by the Bank of England called the CFR, the Climate Financial Risk Forum, and one of the two themes that we are exploring with other financial practitioners across bank, asset manager, insurance is precisely that topic. So I think we can all agree in principle, in the real world, those things kind of are interrelated. What's useful to do in the meantime? So for us, we are that first element. We used to macro stress. We now are getting used to climate. We started to think in terms of what's the extra that climate represents compared to macro, because for a bank, that's really kind of the important question, right? So in the work we've done since the CBES and the work we're doing at the moment is really trying to think about it in this way. We need to think about our financial resources and what happens to them in the combination of macro and climate. We have to take it in step, and there's as well a need to, I think there's an expectation, a need to move fast and developing at pace our capability there. So we have to break it down in bite-sized chunk.
All right, Martin, you want to add?
Yeah, no, I mean, this is a very interesting discussion. It also relates a bit to what the first person was saying. I just want to say on the, capturing climate as part of nature. So we tried to do that in work we done in Malaysia. So we did a nature risk assessment for Malaysia. You may have seen that report. And there we basically look at the exposure, the lending exposure to these sort of different ecosystem services. We also include climate risk exposure as part of this broad bucket of nature. We don't go as far into climate or nature risk stress testing there just because I think the scenario development on the nature side, as you know, is still not there, right? It's very hard to see the systemic scenarios, though we try to, I think, rank a bunch of more localized scenarios. And then I think the exposure to greenhouse gases is also popping up as one of the bigger type of exposures. But, these are first steps, baby steps in that direction. I just want to make two other points on, how to capture that, this broader thing. We look a lot at compounding, really how they interact, also with the macro environment, the nature environment, how you get to these type of scenarios. I think that's definitely one way to go. For supervisors, it will be very hard to then say, like, what do we expect from you to compound, where do we set the limit or so. And one last point that I want to make is, obviously there is a traditional stress testing, which we should not forget from a prudential perspective at least, which is just looking at sort of drop in GDP, where you often end up also with this sort of work. There's all sort of granularity, which makes it different, but to some degree you can also capture the broad, very broad range of like multifaceted of risks through that. But then again, I also think there's a lot of value in being more specific. But where does it end, right? How many things are you going to compound? How difficult are you going to make it?
Thank you.
Anyway.
Thank you. Next question. Okay. All right.
This has been a fascinating panel, and thank you so much for all your excellent inputs. Now, if we were to bring this excellent conversation into a business board context, and you have to present to your boards, there is clearly a lot of work to be done in order to pin things down, get the scenarios going, get the compound effects, so on and so forth, and tail risks. Until you get to, let's not call it semi-perfect, but semi-approximate of how things are going. What are you proposing to your boards to do? Because your risks are running concurrently, even though you cannot model them. And presumably your credit effects are already occurring because climate is progressing as it is. So you must have some increased risk events that are actually happening in your portfolios. What are you proposing with hand in heart to your boards to do? Put additional capital aside? What are the provisions that you're putting in place until we get the intellectual process to catch up with reality? My name is Tina Mavraki, I'm a board director.
Thank you. And the question is directed to anybody in specific, or? All those. So let's start with Billy. Okay.
I'm happy to go. I completely agree with the sentiment of the question, which is why I started my address with what do we do with it, and why do we do it, and what do we do with it before going into the kind of piping and plumbing of how to do it. So I think for us, and those stress tests do go to the board, so on at least once a year basis, we have those conversations. And you're right that part of it is about what scenario did you pick and what did you do there, and that's kind of the what you would expect in terms of pressure testing things there. But then it's about what do we do with it and the learnings. And initially, those exercises, when we started them, were dubbed exploratory. And as time passed and as time passes, it's more and more about how does it affect an impact strategy. So we started putting them into our capital calculations in a way that is crude and rudimentary. And by the way, there's a regulatory expectation that we do that. Although they accompanied with an acknowledgement that of all the things we discussed about it being less, etc. So that's one, and that's kind of important from a prudential standpoint. It's important as well as it then can trickle down into decisions. And then we have a number of, let's say, strategic reviews, and those reviews increasingly use the impact coming out of those stress tests. Yeah. And I mean, certainly from the conversation with our board, they don't treat it as an intellectual exercise. It's treated as the kind of, what are you doing? And so they look to me as kind of risk. What are you doing from a risk framework standpoint in order to recognize that? So we have started to, we run risk appetite across, we have, the way we manage risk is we have series of constraints, and then we do stress, and then we limit then activities, and we've already started to put down payments in all of those categories in order to drive the shape of the activity that we do at portfolio level. And but it's a work in progress. It's putting the best foot forward and trying to work to complete the framework and to complete the picture.
Thank you, Martin.
Yeah, it's a very nice question. Again, can result in a very long answer, but I think one aspect that I want to mention is the Basel Committee's principles for the industry and for supervisors on how to tackle this issue of climate risk. I think is super informative. It both gives guidance to what banks should do, and it also gives guidance to supervisors. You know, if I look at the bank level, you know, I think Billy can speak to it from an advanced country, but in general, what we see in developing countries is, I mean, there's the need for developing this higher strategy. I think that's also where you guys started, and have, you know, stress testing as part of a broader view on how you deal with net zero and green finance and adaptation, etc. But also this part, build the governance internally, you know, have the right committees in place, have someone at the board level be really responsible for it, and then also make sure it's really in your risk management at the different levels, right? The 3 lines of defense, I think they often call it, right? That the internal accounting, the risk management function, but also the loan origination, right? When you are talking to your client and try to find out things, and then set the right mitigating steps in place. And, you know, it's very fascinating to hear about the capital being already really, you know, put forward to this, because that's probably where a lot of them banks will move to. On the supervisory side, just to preempt a little bit, also what you are going to say is likely what we usually say to supervisors in emerging markets: really build that understanding, you know, because they have not always have that, and build the capacity. You have all this modeling, build the data sources, again, set up your governance structure, have, you know, this Frank Elderson person in your board, then set up supervisory guidance based on that. Build your supervisory systems to really monitor it, because otherwise it doesn't have teeth in the end. And also think about the broader, you know, green finance agenda and what role you have. And you may have like specific elements that you can tackle there.
Thanks. Then I'll start with the supervisory part. I fully agree with what you just said. I think having a supervisory guidance to sort of show the way to financial institutions to what you expect them to do in terms of managing these risks is key. We have that. We are still working on building knowledge at the supervisors, because climate, now nature is, I mean, they're becoming more popular, but they are still new topics, so we're still building knowledge on the topics. And indeed, when it comes time to actually check that those supervisory expectations are met, to actually be able to do that and to enforce that. That's more on the supervision side. Of course, from the more central banking financial stability perspective, we've done this first stress tests. I think what it makes sense to continue doing is to continue this further, also with the NGFS. And then maybe, well, better stress tests, of course, lead us to understand more the risks, but maybe there will also be more tangible consequences coming from more relevant stress tests that we will be able to develop. And of course, the awareness raising comes with all that work. So I think advocating a timely transition is what the results of all stress tests show and that we support. And then finally, policy-wise, we are more of the opinion to, even though it might be sometimes early to have a specific policy tool, we are of the opinion that policy tools should be there in case we need them in the future. So, because the legislative process takes a long time of implementing new measures, we're a bit supportive of the side that maybe it's good to have the tools there in case needed rather than wait until it's too late and then it's just too late.
Thank you, Julia. I know Jacob had a question in the back, so, and he has the mic.
Thanks. Really quickly, Jacob Tome from Inevitable Policy Response and the Finance Labs. A quick question to Martijn. I was struck by the lack of heat wave materiality in your charts. This feels like kind of the third leg of the story, which is the social implications and conflicts from heat waves. Would be keen to hear you elaborate on that. And then a question for Julia. I know we've had the conversation about environmental risk outside of man-made risk. What are your thoughts about the fact that environmental stress testing is still exclusively focused on sort of human influences like climate change and impacts on nature and biodiversity, rather than a broader suite of environmental risks facing society, like, for example, volcano eruptions or other changes to our geosphere?
Sorry, could you repeat the first? I missed, couldn't hear it.
So the heat waves were the least material part of the climate risk story in your analysis. But when you consider the potential social dislocation from over 1 billion climate refugees by the middle of the century, these seems inconsistent with what we know about the broader impact of heat waves. And I was wondering if you could elaborate why the World Bank considered heat waves the lowest of the material risk from the different components that you highlighted.
I see, okay. Okay. I would need to look at that chart a little bit better if heat waves was, assessed as the lowest material impact. So I think you're referring to the chart on my first slide, right, the CCR. So that work has been done by over hundreds of colleagues, to be honest. So I've not, developed that particular chart. I do think what I can say about heat waves. So I think the topic of water stress in general and drought, etc., is something that has come up quite recently for us. So we looked into it in Morocco, in particular, in depth. We started to look a little bit into heat waves, I would say, or the effects of extensive droughts in South Africa, where they had this day zero in Cape Town. But particularly heat waves, I don't think we have unlocked that really and what that means. And I think it's a very interesting topic if you think about South Asia, etc., and how that can, affect what's going on there. Is definitely a topic that we need to look into much closer. I think we're now in a big heat wave everywhere in the world, so this is a very interesting one. I had already expected a very difficult question from Jacob, but he's even going further than that, and he's actually helped. He's one of the guys who helped at DNB and us develop a lot of the initial foundational stress testing. So great question. I don't have the full answer, but it's definitely something that is not yet enough integrated, I would say, in some of the stress testing work that we do, and I will take a much closer look at that chart that you were pointing out on how that has played out there.
Yeah, okay. Did you want to add to this question?
Yeah, I had a bit of a different question, I think, from Jacob. So if I understood correctly, environmental stress testing is still focused on the sort of human-induced nature degradation rather than non-human induced, such as volcanoes. I mean, we haven't been in a position to have a real environmental stress test yet. So we have some preliminary scenarios. They're an initial try, by the end of this year, DNB will publish the first nature scenario analysis. They indeed are more on the human-made aspect. It's not that it's unimportant, I think it should be considered. It's just maybe a bit more difficult in terms of action. I mean, the things you produce yourself, there's more on the transition side, you can move them more, and the volcanoes, maybe we cannot influence that easily. And yeah, in the Netherlands, at least, most of the risk is from man-made disasters. Also, if you consider global warming as a cause for flood and so forth. But it's not that we exclude them. It's just that we're in the very initial stages of measuring this risk. And yeah, at least for the Netherlands, this is not top of mind yet.
Did you want to add something at the end?
Yes, just to add, I just took a very quick look at the chart. So this is a chart from S&P Global. So I think they're also, you know, somewhere in the building. So you need to go to them, Jacob. I'm happy about this because get something off my chest.
You got off the hook, right? Okay.
Yeah.
I know there are a lot more questions, and we kind of seriously overshot our time allocation here, and I've been kind of watching the back of the room with a lot of signs and hand wavings. So we got to end here, but I would encourage you to come talk to the panelists one-on-one. And before we end the session, I also have a lunch announcement that I was supposed to make. And this is about dining tickets. Some dining tickets are now available for purchase, and if you want to buy them, please see Patricia at reception. Right? Anyways, that was marketing. But with that, let's give a hand to the panelists.